Income planning for your lifetime. Let's chat about it. When it comes to saving and investing, for most of us, it's pretty simple and straightforward throughout our life, right? Save more, spend less, invest in what you understand, be diversified, right? Don't put all your eggs in one basket. However, when the day comes that you decide to retire, or maybe in the years of, leading up to retirement, it can be wise to be strategic, maybe more intentional with how you're investing and where you're investing your money. There's all different types of investments and all different types of accounts. For example, you've got pre-tax accounts, tax-free accounts like Roths and HSAs, and then you've got taxable accounts. And the order in which you pull money out of and how you invest within each of those types of accounts can make a huge difference over the success of your retirement and how efficient you are, not only from a tax savings perspective, but also from an investment and rate of return perspective as well. So let's dive into some of these phases in life. I like to kind of chunk it up into three buckets or tiers where we have the short term, medium term, and long term. I would consider short term cash flow needs as 2 years or less. In other words, if you had a goal to, when you were to retire, you're going to move across the country, be closer to family, or you're going to buy a cabin, or you're going to pay off all your mortgage the day you retire, whatever it is, and that's kind of within a 1 to 2 year time frame, we want to be pretty conservative with how we invest those assets, unless we have some flexibility. Like if you say, hey, the stock market's down, I can be flexible with the timing. Okay, now we're going to move that maybe more into the medium term risk. But let's say that, you may still have a young kid at home and you want that kid to be in a good school district and you don't want to have to move mid school year. You've only got a couple of months in which you need some money to buy this new home. Well, you don't have a lot of flexibility, and we want to be really conservative on how we invest. So small, short term, we're going to say 2 years or less. Medium term, I'd say from 2 to 7 years, maybe 10 years, depending on your situation, but let's just say 2 to 7. And then 7 years plus, that's long term. So an overly simplistic approach to this might be short term assets, money that we need within 2 years. These are the types of investments or places I'd park some cash. High yield savings account, money market fund, certificate of deposit, CD, ultra short term US treasuries, or other really conservative, high quality short term corporate debt. That's kind of the place I'd park some of that money. Medium term investments I might consider to be bonds with medium to maybe a little bit longer duration. Duration is a metric we look at with bonds to determine essentially how long we're loaning money out before we get our money back. I might look at pretty conservative stock positions, primarily in the US, maybe like a large cap value fund. So companies like a Home Depot, Walmart, McDonald's, like, if there was a recession, typically these types of companies aren't as cyclical in their profits. In fact, they might have a little anti-cyclical treatment, right? If we go into a recession, typically more people eat food at McDonald's or shop at McDonald's as opposed to going to Whole Foods or some fancy restaurant. PF Chang's. Now, I'm not sure if you consider PF Chang's fancy, but I just took my wife out for our anniversary and went to PF Chang's, and for us, that's a pretty nice dinner. So that's kind of the medium term there. And then the long term, that's going to be our growth oriented assets, maybe more of our risky portfolio. Things would include small cap companies. So, and when we say small cap, large cap, that's just short for capitalization, which is a big finance term that means the value of the overall company. If you're going to go out and buy all of Apple, for example, that's a large cap, you're going to need some deep pockets to buy all of Apple. But if you're going to go out and buy some pool cleaner business that's pretty small and just kind of regional, maybe a couple of states, but is public, maybe that's small cap. You're still going to need some deep pockets, but certainly not as deep as Apple. So small cap, small size companies, medium sized companies. Maybe we have some international companies that we own outside of the United States. And we can kind of categorize that into two buckets in and of itself, We might say developed and developing in terms of, or emerging markets is another word for developing, right? Developed countries that have investment opportunities for us might be Canada, countries in Europe like England, France, Germany, countries like Japan, for example, that have established markets and the rule of law and things that kind of reduce that risk to an acceptable level. Emerging markets, on the other hand, might be investing in companies that are located in China, India, Mexico, for example, where they're growing, there's opportunities, but maybe there's a little bit more risk. There's not as much compliance, regulatory environment, not as favorable in those places. We might also include things like private equity there. We might include private credit in the mix. And depending on the types of investments that you use and how much money we're talking about as a percentage of your portfolio, we might shift between the medium and the long term there. But the reason I present these to you as kind of three categories is to help you recognize that as you age and get older, instead of us accumulating assets, we're now in the de-accumulation stage. In other words, we're taking money out to live on in retirement. And when we take money out, oftentimes we'll pull from the short-term assets first. Remember, that's the cash equivalents, and short-term bond funds. And then to replenish that, we may sell out of our medium-term investments and move more into the cash. And alternatively, or I should say not alternatively, but in line with that, we're going to sell some of our more risky assets to replenish the medium-term ones. That's one approach. I find it pretty simple, easy to understand, and favorable in many situations. Let me present to you a scenario. Let's say you just recently retired. Congratulations. You and your spouse are anxious to travel, go on cruises, volunteer, do whatever it is that you care. Maybe you're going to go fly fish with me here in Utah. That'd be fun. And now all of a sudden, at the same time, though, the stock market's down. Maybe a new president got elected, there's new tariffs or changes to Social Security or whatever it is you're not a fan of. Maybe you didn't vote for him. Maybe you did vote for him. Who cares? The market is down. Well, that can be a tough time to start taking money out of retirement. And if all your investments are kind of the same way they were as you were saving throughout your life, you may find that you're being forced to sell your investments at a loss at a really unfortunate time in those first few years of retirement. This is what we call a series of return risk. That's a big technical finance term, but essentially means that if you take a big hit at the beginning of you taking money out for retirement, it can have a lasting impact for decades to come afterwards. This is why asset allocation, or putting your investments in the right place, given your phase in life, is so important. Let me paint another picture for you. Let's say the stock market's up. It's positive. In fact, it's never been higher than it's been before, and you're out fly fishing in Utah or somewhere exotic. And you decide, hey, yeah, I need some money to take out to live on in retirement. Instead of you pulling from the short term, the boring stuff, remember the cash equivalents, the short term bonds, that kind of stuff, it may make sense for you to go ahead and harvest some losses. Maybe instead you sell from that long term position, the high growth stuff, and you use that to live on. And that might make sense too, because let's just take one more step back here. Markets go through swings, and over a long period of time, your growth-oriented portfolio, odds are, is going to outperform the boring stuff, the bonds and the other stuff you have in the mix. And you may get out of whack. So you may have a target mix of, let's say, 60% stock, 40% bonds. But over the last few years, maybe that 60% stock has grown, and now it's more like 70% stock and 30% bonds. Well, you're retired. You don't want that additional risk. And so maybe you go in once a year, twice a year, whatever it is, and you readjust. You sell some of the stock, buy more bonds in your portfolio. That's an important thing to consider as well. If you're using target date funds, which a lot of you use inside of your 401k, they don't offer as much flexibility and control. They're great while you're saving and accumulating assets. They're wonderful. And they're not all created equal. But let's say you have a good quality, low cost index target date fund. The older you get, or the closer you get to the year on that target date, the more conservative those investments will get. And that will happen for you automatically. The fund manager is going to do that for you. But if you have money that you're living on in retirement and it's from, maybe you're not even living on in retirement, it's just in a brokerage account, so it's outside of a 401k or IRA, it's not going to be as tax efficient as if you do tax loss harvesting and tax gain harvesting on your own. I just published another episode on that, so be sure to check it out. But tax gain harvesting and tax loss harvesting are extremely valuable and something you don't get access to if you're in a target date fund in a brokerage account. So just realize as you age, as you get older, it can make more sense to have a little bit more control, be a little bit more intentional about not only where you're saving, but where you're pulling money out from in retirement as well. I want to just share with you one last idea to consider. I mean, that's why you're here, right? Ideas, valuable insights. Hopefully you find this valuable. I have a fun time doing it. When you get older, so let's say you've been retired for a number of years now, and you're thinking to yourself, I want to leave behind some money to my kids and grandkids and leave a little bit of a legacy here. Which assets or investments should I give to the kids and the grandkids? Or maybe you want to donate to charity. You have some philanthropy goals in your life. I want you to recognize that there are certain assets that are wonderful to leave behind, and there's others that come with a lot of tax burden associated with them. Let me just give you a little bit of insight here. If you own a home and you pass away and you give that home to your kids, they get a step up in basis. So let's say you bought the home for $250,000 and now it's worth $1 million. If you pass away, the kids inherit it, and if they turn around and sell it for cash, it's as if they bought it for $1 million, they sold it for $1 million, no gain. They don't have to worry about the income tax or capital gains tax associated with it. If you give them the home before you pass away, well, now that's a totally different ballgame because they adopt your tax basis. So in other words, it's as if they bought the home at $250,000, and if they now turn around and sell it, now they're on the hook for the $750,000 gain, the depreciation. Let me give you another scenario. Let's say that you no longer need that home. You're going to move in with the kids. If you sell the home and you've lived in it for 2 out of the last 5 years, then under current law, you can exclude up to $250,000 in appreciation or gain in the value of your home, or if you're married filing jointly, $500,000. So in this example, if you're married, you bought it for $250,000, today it's worth $1 million, you can sell it. The first $500,000 of gains excluded for federal income tax, and you'd be on the hook for $250,000 of capital gain. Of course, this assumes you didn't make any improvements, you didn't fix the roof or other things, because that would all increase your basis, or in other words, reduce the amount of gain that you would be subject to. So when you're selling assets or trying to give cash or gifts maybe to family members, keep that in the back of your mind. If you leave behind a Roth IRA, it's wonderful to leave behind to kids because the kids inherit it completely tax-free. And let's say you pass away tomorrow, okay? The kids get the Roth IRA. They've got 10 years, assuming they're not minors, they've got 10 years in which to take that money out. But they can wait until the end of the 10th year. And for 10 years, you've given them a tax-free asset to enjoy. A lot of flexibility. If you give them an IRA or a 401k or a 403b, however, well, now your kids, inherit not only the asset, which, let's face it, is very gracious of you to leave them anything, I think, but they also inherit a tax liability. And you may ask, what's the tax liability? Ignoring the death tax or the estate tax, which is pretty high right now. So unless you have kind of double-digit $1 million, you probably don't have to worry at the federal estate tax level. But they have to pay ordinary income tax on those distributions. So let's say you leave little Susie $500,000 in an IRA. She gets that $500,000, and she's got to take it all out by the end of the 10 years. Let's say she's smart about it. And for her, it makes sense based on when she models it out in her financial plan to take 1/10 of that IRA each year for the end of the 10 years. Assuming there's no growth in the IRA, which is a big assumption because odds are you're going to keep investing the inherited IRA if you receive it as a beneficiary. But assuming there's no growth, that's $50,000 a year, right? $500,000 divided by 10 years, 50 grand. That 50,000 is going to be treated to her as if she earned the income. It's as if she got a $50,000 bonus or a $50,000 raise at work. Now, she's not going to be on the hook for FICA taxes, Social Security and Medicare tax, but she's definitely going to be on the hook for federal income tax and maybe state income tax, depending on where she lives when she takes the money out of the inherited IRA. So there's 3 different types, right? We get the step up in basis with real estate and brokerage accounts. We get tax-free treatment continuing on for a limited time with Roth IRAs and Roth 401ks. And then you get the ordinary income tax liability passed on to the kids when they inherit with what we call required death distributions, RDDs. Now you know. My name is Rizek. I'm a financial advisor. I'm a CPA and certified financial planner. If you've enjoyed this, you'll love my new book, Finance on the Fly, Simple Strategies to Build Lasting Wealth. You can pick it up on Amazon. For the cost of a burrito with guacamole, I think you'll find an enormous amount of value in here and help you make better decisions with your finances. This is not purely just another investment book written by some financial advisor. We're going to dive into tax planning and tax strategies that you, the average American, can take advantage of. We're going to look at estate planning, when to consider life insurance and when not to, where to take money out from when you retire, and what's the best way to donate to charity when the day comes. In fact, let me just give one more shout out here on charitable giving. When you donate assets to charity, let's say that's part of your end game, your end plan here. Which assets do we want to donate? The taxable ones that get a step up in basis, the Roth, the tax-free stuff, or do we want the stuff that still has an ordinary income tax liability, like money from a pension or an IRA or a 401k? Probably doesn't take a genius to figure out that we want the pre-tax stuff to go to that charity. We want the IRA to go. Remember, the IRAs, the 401ks, there's still a tax liability associated with them. But if we give that money to a qualifying 501c3 organization, a charity, a church, something like that, then we give them that asset. And because they're tax exempt, they're not on the hook for that tax liability when you give it to them. So from a tax efficiency standpoint, much wiser. And for those of you who are 70 and a half years old, you got to love the stupid half-year conventions that's in the U.S. tax law. 59 and a half this, 70 and a half that. I mean, just all over the place. We'll see what happens with Social Security, but I wouldn't be shocked if they pushed out full retirement age from 67 to 67 and a half. Just sounds like the thing to do for them. But when you turn 70 and a half, you can give money from your IRA to qualifying charities up to $100,000 per year, any amount up to that, and not pick it up as income. It doesn't even show up on your tax return. It's called a qualified charitable distribution, a QCD if you want to sound like the cool kids. And it's such an extremely powerful strategy if you're thinking about leaving money behind towards the end of your life. All right, there you go. If you want more on charitable giving strategies, you'll love the chapter in my book where we talk about donor advised funds, donations in kind, and charitable trust, just to give you a taste of what's to come.
The Finance on the Fly podcast is for educational purposes only. Any ideas presented are not intended to be personalized financial, tax, or legal advice and are provided for informational purposes only. Rizek is not rendering or offering to render personalized investment, legal, or tax advice through this content. Investing comes with risk, including the risk of loss. Consult your own tax professional, financial advisor, or estate planning attorney to perform your own due diligence.